Now you have a new responsibility, submitting a tax return. At first glance, it looks complicated and confusing. But after this video, you will know everything you need in order to submit tax return correctly on your own and obtain all benefits and avoid any fines. Hello, my name is Aryuna and I have been working as an accountant in New York for over 17 years. I am familiar with all the intricacies and easiest ways to handle this process. The first step is to collect all necessary documents. Which ones? Social Security number and work authorization for all family members. If you have children, birth certificates for them. If you worked on W-2, this is the form that your employer has to provide before January 31st. In most cases, people work either on W-2 or self-employed. If you're self-employed, you need to calculate all your income from any side jobs you may have. I recommend downloading all your bank statements and calculating all incomes that have been coming into your account. If this is your first tax return, you might find it hard to understand where to provide information during the process. For beginners, I recommend writing down all expenses. Review all your statements and compile all receipts categorized by expense type. I suggest using Excel for this. You can download an example below. When preparing documentation for your tax return, go through the list with your accountant. Depending on your situation, the specialist will determine whether a particular expense is deductible, eligible for a credit, or subject to a deduction. These are three different things. If you are self-employed, you can deduct business expenses. This is called deductions. What are these expenses? All expenses related to business activity. For example, if you're a makeup artist, this includes all makeup purchases, any instruments or tools such as mirrors, brushes, etc. If you're a construction worker, this would include materials and tools. I recommend writing down all expenses by categories. We include anything that was purchased in the calendar year of 2024, for instance. In some cases, purchase of assets such as vehicle, computer, camera, phone can be deducted in this year even though they were purchased in the earlier years. These assets are deducted starting from the moment they are used for business activity. For example, Anne came to the USA in 2022 and purchased herself a car. She didn't know what she would be doing at the time. She needed a car for the transportation. In 2022, Anne didn't work and therefore couldn't use her car for deduction purposes. However, in 2023, she started working as a part-time food delivery and uses her car for it. Even though she paid for her car in 2022, she can deduct this cost in 2023 using a few methods. Which ones? I will explain it in the next video, so subscribe to the channel and save on taxes in the USA. I can provide the most common examples of how to deduct self-employed income. Purchase of a phone or service, payments for internet, everyone needs to search for information and advertise their business. Home office, and any expenses related to vehicles, gas, repairs, tolls, insurance. Most importantly, calculate all your expenses. By the way, if you need help with deduction of your expenses in the correct equivalent depending on your situation, schedule a consultation and analysis with me. The booking link is in the description. Remember, if you have categories of expenses that can be considered as personal use, it is important to correctly calculate the percentage rate working and personal use. Most of the people use standard deduction. This method is available to anyone in this case, in any case. Standard deduction depends on your marital status on the tax return. The standard deduction amount depends on your filing status. The standard deduction amounts for 2023 are single or married filing separately, $13,850. Married filing jointly, $27,700. Head of household, $20,800. There is also an itemized deduction, which is used when it exceeds the standard deduction or when you are required to use it due to ineligibility for the standard deduction. Itemized deduction method includes only some expenses such as mortgage interest, part of real estate taxes, part of state and local taxes or sales tax, part of medical expenses, donations to religious or charitable organizations, and certain losses from natural disasters. In my personal experience, itemized deduction method is used by homeowners who have significant amounts in mortgage interest and property taxes, which exceeds usually the standard deduction. People who recently arrived usually rent an apartment, which is not included in itemized deduction, have free health insurance, so there are no medical expenses, and do not make large donations to charitable organizations. Most people receive refunds through credits. Additionally, if you're self-employed or a business owner, in addition to itemized or standard deduction, you are entitled to the qualified business income deduction. This deduction allows eligible taxpayers to deduct up to 20% of their qualified business income from conducting commercial activities, QBI, plus 20% of their qualified REIT, dividends and publicly traded partnerships, PTP income. Tax credits are a key factor that every taxpayer filing a tax return should understand. Most people, especially those with dependent children, receive refunds through these credits. Misunderstanding or ignoring them could lead to a loss of refunds. Incorrect filing can result in credits that you were not entitled to, requiring repayment with interest and penalties later on. The most popular credit is the Earned Income Tax Credit, EITC, which helps low to moderate income workers and families receive tax benefits. If eligible, you can use this credit to reduce taxes owed or even increase your refund amount. You may qualify for the EITC if your income is low or moderate. The amount of your credit may vary depending on whether you have children, dependents, disabilities, or other criteria. To qualify for the EITC, you must work and have earned income of less than $63,398 in the 2023 tax year. Have investment income of less than $11,000 in the 2023 tax year. Have a valid Social Security number by the due date for the filing of your 2023 tax return, including extensions. Be a U.S. citizen or resident alien for the entire year. Not file Form 2555, related income earned in a foreign country. Follow specific rules if you live apart from your spouse and do not file a joint tax return. Other popular credits you may qualify for includes child tax credit and credit for other dependents. The basic criteria to be eligible for the child tax credit, your dependent generally must be under age 17 at the end of the year, be your son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of them, or, for example, your grandchild, niece, or nephew. They shouldn't provide more than half of their own support during the year. They should live with you for more than half of the year. Should be claimed on your tax return in the appropriate manner. Next credit, child and dependent care credit. Taxpayers who pay someone to care for their children or other family members while they work or attend school may be eligible for the child and dependent care credit regardless of their income. In the 2024 tax year, the maximum amount available for this credit is $3,000 per child. Education expense credit. Higher education is important for many individuals and often comes at a significant cost. Whether pursuing a specialized professional training or obtaining an advanced degree, higher education is associated with substantial expenses. There are two tax credits for education expenses: American Opportunity Tax Credit and Lifetime Learning Credit. For detailed information on each of these credits, please refer to the separate detailed videos. Each contains many details. It is also important to understand the difference between federal and state tax returns. Each state has its own rules regarding deductions and credits. As practicing accountant in New York, I provide additional important information. New York State, being a Democratic state, offers significantly large deductions and credits. However, it also thoroughly checks all criteria and often requests additional information to support your income, expenses, and deductions. If you're located in New York, be twice as careful when filing your tax return. If your income is substantial, consider contributing to your retirement fund, as the tax authorities allow contributions to be made to the fund until April 15th, the tax filing deadline for the 2024 year. At the very end, after calculating all income, expenses, deductions, and so on, I recommend this scenario. What if you deposit a certain amount into the retirement fund? This will reduce your taxable income and potentially increase your deductions because income base used for various deductions will also change. If you fail to account for deductions, credits, or allowances, you're simply missing out on refunds offered by the government. However, if you file something incorrectly, for example, understate your income or claim more expenses than you have, you risk fines, penalties, and further investigation. Sometimes, tax authorities will issue a refund, but after some time, they have 3 years to review your tax return. They may check, and if you don't provide correct and complete information, you may not only have to return the refund, but also pay recalculated tax, interest, and penalties. Deductions and credits are very effective tools for reducing taxes in the United States. To learn more about additional tax reduction techniques, watch this video.